Hello, my strategic We Can Do It women. I'm Deborah Morrison, and today we're talking about the powerful financial moves you can make before the year ends. That could save you thousands in taxes, position your finances for growth, and set you up for your best financial year yet. The time between Thanksgiving and December 31st isn't just for holiday celebrations, although that's fun. It's prime time for year-end financial optimization. Yes, it is. The women who take advantage of these final weeks of the year often start January thousands of dollars ahead. Today, I'm walking you through exactly what to do, when to do it, and why it matters. Why year-end financial planning matters? Well, December 31st is more than just a date on the calendar. It's a hard deadline for many financial opportunities. After midnight on New Year's Eve, the tax deductions for this year disappear. The contribution limits are basically reset. Required minimum distributions must be completed. Various opportunities expire. So smart year-end moves that could impact your tax bill and potentially save you thousands of dollars. You want to do that, right? You want to do smart year-end moves that could impact your investment growth, your retirement readiness, your charitable impact, your insurance costs, your financial organization. So move number one, maximize those retirement contributions. Yeah, 401k for profit corporations, 403b for not-for-profit. And the 2025 limit is 23,000 plus 7,500 of extra catch-up contributions if you're 50 and older. Check your year-end or check your year-to-date contributions relative to what they're going to amount to by year-end, and increase your final paycheck's contribution if your plan contribution isn't maxed. Then you're going to get your full employer match if they're matching. Now, example of the savings of $10,000 or more is significant. If you're in a 20% tax bracket, you're going to save $2,000, right? In tax savings. If you're in a 24% bracket, you're going to save $2,400 in tax savings. Plus, the investment grows over time. Plus, employer match, which is often the case, 50% to 100%. IRA contributions. Good news. You have until April 15th, 2026 to make your 2025 IRA contributions. The traditional IRA limit is $7,000, $8,000 if you're 50 and above. Your Roth IRA, same limits. Income restrictions apply, though, to Roth IRAs, so you've got to be careful about that. You may need to do what's called a backdoor Roth. Okay, but considering doing it now, anyway, you have extra months of market growth to work on your behalf. You have one less thing to remember in tax season, and you're going to confirm that you have these funds available, and you're going to do it. Move two, tax loss harvesting. If you have investments in taxable accounts, not retirement accounts, not your Roth, not your IRA, not your 401k, taxable accounts, review those positions that are now showing losses and sell those losing positions before December 31st. Each dollar loss offsets a capital gain, i.e. if you sold a position in which your market value was in addition to or greater than that which you purchased it at, plus your dividends. So your losses offset your gains dollar for dollar. And then if you have losses in addition to those gain offset losses, you can go ahead and deduct up to $3,000 per year from your ordinary income. And these are carried forward forever. So it's really valuable to lock in tax losses. And if that is how this year ends, many of us, instead of just crying in our soup, can actually take pro action. I did it in practice, hundreds of thousands of dollars of tax losses, and it's so beneficial. It is so, so rich. And you're going to reinvest then in similar products to that which you sold, but not identical, because you need to be sure that you do not run afoul of the 30-day wash sale rule, which means you cannot buy the exact same security within 30 days. Else, the tax loss that you declared from that initial security will be disallowed. So here's an example. Stock A gained $5,000 this year. Stock B lost $3,000. You sell stock B before year end, and your net taxable gain reportable on your taxes is only $2,000, not $5,000 from the stock A gains. In a 24% bracket, this saves you $720 in taxes. So again, you're going to wait 31 days. You're not going to buy the identical security. Move 3 is charitable giving strategies. And this is so valuable. If you normally give to charity anyway, you're going to bunch your charitable deductions. And instead of giving $5,000 each year, if you're itemizing this year, you want to go ahead and maybe give $10,000 this year if the deductions are going to help you. If you're on standard deduction, it's not going to help. And then give 0 next year. So you might phone the charities if you know them, smaller charities that you may know the executive director and so forth. And you say, look, from a tax angle, it behooves me to go ahead and give you $10,000 before year end, but I'm not going to be able to give you any more in 2026. And then alternate years for tax bracket. Remind yourself, you can do itemized deduction or standard deduction. You can flip-flop them every other year. It doesn't matter. You want to plan that and plan your last 2-3 months of transactions accordingly. Use appreciated stock instead of cash donations to charities. You donate stock that's increased in value, you get the deduction for the full market value of the contribution, and you avoid paying the capital gains tax, which you would have had to pay if you cashed that out and then gave cash to the charity. The charity receives the full amount because they're tax exempt. So here's the example. You got a stock worth $5,000 that you only paid $2,000 for. You donate the stock, you take a $5,000 deduction, no capital gains tax to you. The charity sells the deduction, uses it for their cash flow. But if you, in fact, sold that stock worth $5,000 that you otherwise paid $2,000 for, you would have to declare a $3,000 capital gain. And then you're going to donate the cash to the charity. But remind yourself, you just have to pay the tax on $3,000. So it diminishes your gift, or you have to come out of pocket in order to match that which you wanted to give them, which is $5,000. Again, it saves $720 in a 24% tax bracket. And so now we can talk about qualified charitable distributions, QCDs, right? If you're 70 and a half or older with an IRA, you can donate up to $105,000 directly from an IRA to charity. Yeah, it's just like, boom, direct, like trustee to trustee. It counts towards your required minimum distribution. So this is one way you can reduce your required minimum distribution legally. It's not includable in your taxable income because you didn't have constructive receipt. It just went IRA to the charity. And so even if you don't itemize deductions, you're good. It's a really sweet deal. Move number 4, required minimum distributions. We just spoke of it. RMDs. If you're 73 or older with traditional retirement accounts, you must take your RMD by December 31st. The penalty for missing this is like really severe, 25% of what you should have withdrawn. And you can calculate this using the IRS tables. You can calculate, it's called the uniform table, and you can calculate how much you have to take. Remind yourself, you have a bunch of different IRAs. You've got to do it for the sum total of them. And I'll just give you a caveat here. If you might have an annuity or a life insurance policy with excess death benefit attached to it, you need to call the insurance company and ask them what amount you have to put away. No, it's not in life insurance. I apologize. It's a variable annuity or a fixed annuity that is qualified. Okay. And that really is an important thing that many people miss completely. So here's an example of the penalty. If you should have withdrawn $8,000, but you didn't, the penalty is $2,000. Plus, you still owe the taxes on the $8,000. Plus, you still must take the distribution. So move 5, flexible spending account, FSA sweep. These are really very, very effective. Most FSAs are use it or lose it by December 31st. So check your balance, schedule your doctors and dentist appointments between now and year end, fill your prescriptions, buy eligible items, glasses, contacts, first aid supplies. Don't let your money disappear in the plan. So common FSA eligible expenses include medical copays and deductibles. Keep track of this, right? Prescription medications, over-the-counter medications with a prescription. Glasses, contacts, solution for your contacts. First aid supplies, some sunscreens, feminine hygiene products. And move 6, review and adjust your withholding. Are you expecting a large refund? If you are, you're not going to get any interest on that money that Uncle Sam held for however many months, and you're not going to get a thank you. So let's adjust our W-4 for 2026 so that doesn't happen. Or if you owe more than $1,000, again, you're going to adjust your W-4 so that you're not shocked next year from a cash flow standpoint. Large refunds basically amount to interest-free loans to the government. Large tax bills equal potential penalties. Now, let's optimize our withholding. We're going to aim for a refund, i.e., that's owed within $500. You're going to use the IRS withholding calculator, yes. You're going to submit a new W-2 in January, and you can ask your HR department to help you with this. Move 7, health savings accounts. Wow, this is an untapped market for so many of us. HSA contributions. If you have a high deductible health plan, and that's the criteria, the maximum contribution in 2025 is $4,150 for an individual, $8,300 for a family, plus a $1,000 catch up if you're 55 or older. This is a triple tax advantage. You get to deduct this contribution. It grows tax free, and the withdrawals are tax free if they're used for qualified medical expenses. Wow. I used an HSA for only about 4 or 5 years, and I have like $30,000 in it because you can invest it in the stock market or wherever you want. So HSAs are powerful because it reduces your current year taxes. Your investment grows tax free. Medical withdrawals are never taxed. And after 65, you can use it for anything, and the withdrawals are actually taxed like an IRA withdrawal. Not the end of the world because you've had tax-free compounding all of those years, maybe decades. Move number 8, coordinate your medical expenses. Like if you're close to the 7.5% of the AGI threshold in order to deduct medical expenses on your itemized deductions, you're going to bunch the medical expenses into 1 year if you can. Schedule elective procedures, pay outstanding medical bills, stock up on prescriptions, get new glasses, hearing aids. So let's say your adjusted gross income is $100,000. You're going to need $7,500 in medical expenses in order to deduct even $1. And you've got $6,000 so far. Schedule $2,000 of dental work that's been needing to be done before year end. Deduct $500 of medical expenses. Move number 9, review and rebalance your investments. Year end is perfect time to review your asset allocation, rebalance the target percentages. Likely you're not doing this on your own. Your fee-only fiduciary advisor, your certified financial planner who does not receive any commissions, that person is going to help you review the asset allocation and do the appropriate rebalancing trades so that you are back on schedule. And check if your investments are still aligned with your goals. Eliminate redundant holdings. You don't want to have the same mutual fund or exchange traded fund in your Roth and your traditional and your brokerage account. That's just not right. It's just ineffective and suboptimal. Now let's talk about a rebalancing example. Let's say that your target asset allocation, what your fiduciary planner has spoken with you about and you have talked with relative to your current investments and your goals and objectives. Let's say the best target to get there is to have 60% of your portfolio in stocks, 40% in bonds. And let's say you're currently 68% in stocks because the stock market had gone up and 32% in bonds. You're going to sell some of your stock holdings and you're going to buy more bonds in order to return back to that optimal 60-40. So a lot of people have difficulty with this. The do-it-yourselfers, they sell my winners. I can't sell my winners. Well, then I say, no, we're going to sell high and we're going to buy low because markets cycle, you see. It's always more than just meets your eye. And that's why it's important to have somebody that has your back, that has experience, decades and decades of experience, so that you don't miss these opportunities. And move number 10, get financially organized. You're going to use that year end to set up certain systems for success, even more success in 2026 than you had now. You're going to create your 2026 financial calendar. Tax deadlines are going to be put right in your calendar. Quarterly estimated payments, insurance renewal dates, always like a month in advance so that you have plenty of time to shop if you wish to shop. Now remind yourself, do not shop every year just for like $10 in savings because the insurance company, once you have a claim, is going to say, oh, they're just a hopscotcher. They've only been on our rolls for a year. Not so much. But if you've been with a company for a long time and you have a claim, trust me, the payout on your claim is going to be a lot more attractive. So don't be making, a move for, a small amount of premium savings. Financial review dates, bill due dates, and so forth. You're going to organize your tax documents, set up a folder system. I don't care if it's paper or it's online on your computer. You're going to gather all your year-end statements. You're going to prepare for the tax season right now. You're going to find your missing documents right now. And then you're going to update your financial information. Maybe the beneficiaries on your accounts need to be changed. You've had some kind of a family change. Maybe you're going to review your insurance coverage amounts. Maybe you're responsible for more of the family's bills, and your premature death could cause the family a whole lot of hurt. So you want to up your insurance, whether you do it on your own or through your company's group plan. Emergency contacts, they may need to be updated. Your net worth calculation is valuable for you to know. Hey, I'm worth more now. I mean, these are all very, very positive affirmations for us because we tend to think negatively if we're not tracking things. And so often after I meet with someone, they're like, I'm not as poor off as I thought I was, right? As I feared I was. Yes, of course. We always fear something bigger than what really ends up happening. I mean, a lot of time. So now we're talking about additional year-end considerations. Business owners, you may want to time your equipment purchases. You can get a Section 179 deduction for certain types of equipment. That's kind of like a lump sum deduction for $50,000 piece of equipment. That's pretty sizable. If you had like a bang up year income-wise, bam, I'd look around and say, hey, what equipment can I use? Can I use for my business? And take a 179 deduction. Bam, that's going to offset some of that extra earned income, but it must be purchased and in use by 12/31. You're also going to pay some expenses early. You can prepay some insurance. You can prepay some property taxes, outstanding invoices. You can stock up on inventory if you need to. And you might defer income if it's beneficial. So you may not invoice in December if you've had a really good year. You might push those receivables into January. So consider what your tax bracket is likely to be for 2025 versus next year. And homeowners, again, property tax prepayment. Yeah, if you're itemizing deductions, you can pay your 2026 property taxes, at least the first quarter of them, in 2025. That increases your 2025 deductions. Mortgage interest, you can make your January payment in December and deduct it. You got an extra month of interest deductions because you might go on standard deduction and you don't get that mortgage interest deduction. So it varies from year to year. Gifts to family. You can gift $18,000 to each individual person tax-free in 2024, and I think it went up a little bit in 2025. Indeed, it did. It's 19,000 this year for 2025. So this reduces the estate tax for those that are concerned about estate taxes. The threshold is so high now, not so many people are. Nonetheless, if you have extra net worth that you're not going to use in your lifetime, you may be involved in a very sophisticated gifting process, and you might as well gift the monies. This helps out the families now when they need it, and it also helps you in kind of keeping your estate in a reasonable level. You're going to review your insurance. Yeah, your health insurance for 2026. There's open enrollment in December, for example. You want to plan for that right now. You're going to look at your life insurance adequacy. And this is how I talk to people about life insurance. Person A, what are you making? And let's say it's a couple. Person A, what are you making? $100,000 a year. Great. How many years do you want to buy your survivor if you died yesterday? Oh, 3, 5. Okay, great. 3 times 100,000, 300,000. You have a mortgage you want to cover? Yeah, $100,000. Yeah, 300,000, 400,000. Put some lump sum away for your little kid, 25,000. 300,000 for lost income for 3 years, 100,000 for the mortgage, and 25 for the kid. 300, 400, 25. Any questions? I'm not going to sit here and talk to you about what type of insurance to buy. I want you to buy insurance that is going to fill the need, because life insurance it brings no one back. It buys the survivor time, and wow, is it important? It is so important. Let's look at our disability coverage. Let's look at our homeowners and our auto coverage and make sure that we're routing our premium in the most judicious manner. Let's look at long-term care planning. Are we going to obtain long-term care insurance or not? Are we going to self-fund that? There are really creative ways around that. And then let's have a year-end financial meeting. Yes, schedule time with your certified financial planner, your fiduciary planner. A good 90 minutes is what you're going to need before December 20th, for sure. That's the last date. So you're going to review your performance for the year. You're going to check your progress on those goals. You're going to identify successes and challenges. You're going to reset 2026 financial goals. They may be different. And you're going to create an action plan. And you're going to ask yourself, hey, about my income, did that meet my expectations from our meeting last year? Did I get any windfalls or unexpected income? Did I receive side income or bonuses? Did I realize any investment gains in my portfolio? And then relative to my expenses, did I stay on budget? What categories went over? Were there any surprising expenses or those which I missed? What can be optimized in terms of my cash flow and my expenditures? Savings and investments. Did you meet your savings goals? How about the emergency fund? Is it adequate? I mean, we have various and sundry outside influences that perhaps cause you to be flat-footed with regard to ready cash flow. And that's painful. I don't want you to go through that pain again. So if you've already gone through that pain, you know how much it pains you to not have any reserve. So let's start to make a reserve. Start to chip away. Retirement contributions maximized and other goals funded. And then look at debt. Did the balances decrease? Did the interest rates remain competitive? If not, call the company and ask for a more competitive rate. Did you consolidate any debt? Take advantage of 0% interest for an extended monthly, duration? Did you pay off any of the accounts? Has the strategy worked to reducing your overall indebtedness, especially relative to the amount that you otherwise have as a limit? And let's talk about investments. What was the portfolio performance versus an adequate, commensurate, similar benchmark? Is the asset allocation that you were working within still appropriate, or did something seismically change to alter that? Are the fees you're paying reasonable? And yeah, you're always paying fees. People say, "Oh, I'm not paying any fees." No, you are always paying fees. That's just how it works. Some of them are under the hood, but don't delude yourself. And if your broker is telling you, "Oh, there's no fees," that's maybe a good indication to switch to a fiduciary planner right there. And do you need to rebalance? If you had 60-40, now you're 63, what, 20, 37, then you need to rebalance. So we want to talk about the 2026 goal setting framework. Our financial goals should be specifically, I'm going to save 10,000. I'm going to save 15,000. Not, I'm going to save more. More? What? $1 more? It has to be measurable. We want to track our progress each and every month. It has to be achievable. These are attributes of a good goal. Smart, specific, measurable, achievable, relevant, aligned with our values. T, time bound, clear deadline so that we know we're off track. We need to catch up. We're over. Good. Congratulations. The examples that I'm going to throw out for 2026, you might increase your emergency fund from 5,000 to 10,000. That's still woefully small, but it's better than 5. You might pay off $8,000 in credit card debt. You might max out your Roth IRA. You might reduce your spending by $300 a month. You might increase your income by $500 a month through side work. Ladies, these financial decisions and strategies in these final weeks of the year are your opportunity to end strong and start 2026 even stronger. The financial moves you make now can save thousands in taxes, position your investments for growth, and create momentum for 2026. So don't let December 31st arrive without taking actions. Even if you can only implement a few of these strategies, you'll be farther ahead than those who do nothing. Your best financial year doesn't happen by accident. No, it doesn't. It's created through intentional action. And the best time to take that action is right now. So next week, we're going to continue with strategies to make your financial life even stronger in the new year. Subscribe to this channel, join our We Can Do It Women Facebook community, and share this video with any woman who needs to finish this year strong financially. Until next week, remember, December 31st is a deadline and an opportunity. Use these final weeks wisely, and you'll thank yourself all through 2026. I'm Deborah Morrison and would love to hear the details below. Thanks for sharing.